Welcome to this presentation from Quantum House, Sydney's leading accountants and tax advisors. Today we are covering one of the most widely used and most powerful tax planning structures available to Australian families, the discretionary family trust. Used correctly, family trusts offer significant flexibility in distributing income to family members on lower tax rates, protecting assets, and managing capital gains tax. But there is a tension at the heart of this topic, because the ATO has become increasingly focused on family trust arrangements, and the compliance requirements have become considerably more demanding in recent years. Over the next few minutes, we will cover how trusts reduce tax, the critical 30 June distribution resolution, the Section 100A compliance focus, capital gains tax, unpaid present entitlements, and Division 7A, and trust elections. Let's begin. Before we get into specifics, let's frame the central tension of this whole topic. On one hand, discretionary family trusts are genuinely powerful. They allow flexible distribution of income to family members on lower marginal rates. They provide asset protection from creditors, and they give access to the 50% CGT discount, and for business owners, the small business CGT concessions. On the other hand, and this is the key change in recent years, the ATO now actively targets family trust arrangements, and the compliance obligations have become more demanding every single year. As the call-out box puts it, the very flexibility that makes trusts powerful is exactly what the ATO scrutinizes. The benefits are real, but they are only safe when the compliance is done properly. That theme runs through everything we cover today, the 6 topics shown on the right. Let's start with the core question. How do discretionary trusts actually reduce tax? The primary advantage is income distribution flexibility. Each year, the trustee has the discretion to decide which beneficiaries receive the trust's income and in what proportions. The eligible beneficiaries of a family trust typically include the controlling individuals, their spouse, their adult children and other relatives, and a corporate beneficiary. By directing income to beneficiaries on lower marginal rates, for example, an adult child in a low-income year or a corporate beneficiary taxed at 25 to 30%, the trust can significantly reduce the overall tax paid on business or investment income. As the left card notes, this works best where there are multiple eligible beneficiaries with genuinely different income levels. Now, one important technical point, and it's a common misconception worth correcting. The settlor of the trust must not be a beneficiary. The settlor is the independent party who establishes the trust with the initial settled sum, often just $10, and they are deliberately kept separate. If the settlor or their associates can benefit from the trust, it triggers adverse tax consequences and can undermine the trust entirely. The beneficiaries are the family members and related entities named in the deed, never the settlor. If there is one slide in this presentation to pay close attention to, it is this one. The 30 June distribution resolution is the single most critical annual compliance obligation for any discretionary trust. The resolution is a formal decision by the trustee, made before 30 June each year. It must name each beneficiary who is to receive trust income, state the amount or percentage each is to receive, comply with the terms of the trust deed, and be documented in writing. And critically, it is a yearly obligation. It must be done afresh every income year. Last year's resolution does not carry over. Now the consequences. If a valid resolution is not made before 30 June, the trust's net income does not wait for a later decision. It defaults. Depending on the deed, that income is either taxed in the hands of the trustee, potentially at the top marginal rate of 47%, or it is distributed equally among all beneficiaries, regardless of their tax position. This is not a mere administrative slip. It is potentially very expensive, and, crucially, it cannot be fixed after year-end. Once 30 June passes without a valid resolution, the default outcome is locked in. This is exactly why working with an accountant who manages your resolution every year matters so much. This brings us to what is probably the most significant compliance development in the family trust space in recent years, Section 100A. Section 100A of the Income Tax Assessment Act 1936 can apply where a beneficiary is made presently entitled to trust income, but enters into an arrangement under which the real economic benefit of that income flows to someone else. The classic scenario, and the one the ATO is most focused on, is where adult children are named as beneficiaries to access their lower tax rates, but the funds actually flow back to the trustee or to a parent. On paper, the child gets the tax entitlement. In substance, the parent gets the money. Why has this changed the landscape? The ATO finalized its Section 100A guidance in 2022 after releasing draft guidance earlier that year. That guidance set out clearly which arrangements the ATO regards as higher risk, distribution strategies that many families and even advisors had treated as routine for years suddenly needed to be re-examined. So what should trustees do? Every distribution should now be reviewed against the Section 100A principles before it is made. Where adult children or other beneficiaries are named, the funds should genuinely be theirs to use and enjoy. The arrangement should have a real commercial or family rationale, and that rationale should be documented. This is precisely the kind of review that should happen before 30th June, not after. Capital gains tax is an area where trusts offer real advantages, but also where one common mistake can be very costly. First, the advantages. Trusts can access the 50% CGT discount on assets held for more than 12 months, and importantly, that discount flows through to individual beneficiaries when the gain is distributed to them. And for business owners, the trust may also be eligible for the small business CGT concessions on the sale of active assets, which can reduce, or in some cases entirely eliminate, the CGT on a business sale. Now the trap, and it catches people out regularly. Companies do not get the 50% CGT discount. So if the trustee distributes a discounted capital gain to a corporate beneficiary, that discount is lost. The company is taxed on the full gain. You have effectively thrown away half the benefit. The lesson is that the trustee must make capital gain distributions in a tax-effective manner. Where the CGT discount matters, the gain should generally flow to individual beneficiaries who can retain the discount, not to a company that cannot. This is exactly the kind of decision where getting advice before the distribution is made pays for itself many times over. Let's turn to two more advanced areas, both of which matter enormously if your trust has a corporate beneficiary or carried forward losses. The first is unpaid present entitlements and Division 7A. The scenario is this. A corporate beneficiary is made entitled to trust income through a distribution resolution, but the cash is not actually paid across to the company. It stays in the trust. When that happens, the company has what's called an unpaid present entitlement, or UPE. The ATO's position is that these UPEs, from a trust to an associated company, can be treated as loans under Division 7A unless they are placed on a complying loan agreement. And if caught, the UPE can be deemed an unfranked dividend, a harsh outcome. Any business with accumulated UPEs should review its position urgently because the ATO has specifically identified this as an area of systematic non-compliance. The second area is trust elections, family trust elections, and interposed entity elections. These let a trust access certain valuable concessions, including the ability to use trust losses and to transfer franking credits within a family group. But there is a trade-off. Once made, these elections restrict the group of beneficiaries who can receive distributions, and a distribution outside that family group attracts family trust distribution tax at 47%. So not every trust should make one. The decision depends on the trust's history, the composition of its beneficiaries, and its objectives. And reviewing your election status should be part of your annual planning. Let me bring the compliance themes together into the 4 pitfalls that cause the most damage, and that we work proactively to prevent. Pitfall 1. Missing the 30 June resolution. The most common and one of the most expensive mistakes. No valid resolution before year-end means the income defaults to the trustee at up to 47%, or spread equally, regardless of anyone's tax position. And it cannot be fixed after 30 June. Pitfall 2. Section 100A Exposure. Distributing to adult children on paper while the money flows back to a parent is precisely what the ATO's guidance is designed to catch. Distributions now need a genuine rationale, and it should be documented. Pitfall 3. Losing the CGT discount. Distributing a discounted capital gain to a corporate beneficiary throws away the 50% discount. The company is taxed on the full gain. Entirely avoidable. And pitfall 4. Unmanaged UPEs. Unpaid present entitlements to a corporate beneficiary, left off a complying loan agreement, can be deemed unfranked dividends under Division 7A, a systematic ATO focus area. The common thread across all four is that they are avoidable, but only with proactive planning before year-end.
So how does Quantum House help families with their trust tax planning? First, specialist trust expertise, distribution strategy, Section 100A risk, CGT planning, unpaid present entitlements, and Division 7A, and trust elections are core areas of our practice. We work with discretionary trusts every day, and we know where both the risks and the opportunities lie. Second, we get the resolutions done right and on time. We prepare and review your distribution resolutions every year, before 30 June, never after. And we assess each distribution against the Section 100A principles, so your planning is both effective and defensible if the ATO ever asks questions. Third, we integrate the trust with your whole plan. We review your trust structure and bring its tax position together with your broader personal and business tax planning, so your trust works as part of a coherent overall strategy, rather than being managed in isolation. We have served Sydney families since 2010, and we run our trust planning reviews before 30 June. To close, let's make this practical. A family trust is a powerful structure, but it only delivers its benefits safely when the compliance is managed properly, and the most important steps happen before 30 June. So if any of the following apply to your trust, now is the time to talk to us. If your distribution resolution has not yet been prepared and reviewed for this year, if you distribute to adult children or other beneficiaries in a way that might attract Section 100A scrutiny, if you are selling or have sold an asset and want to preserve the 50% CGT discount, if you have a corporate beneficiary with unpaid present entitlements not on a complying loan agreement, if you are unsure whether your trust should make, or has already made, a family trust election, or if your structure has simply never been reviewed against current ATO compliance expectations. Quantum House provides a confidential family trust planning review where we look at all of this and give you clear, actionable advice. You can reach us at quantumhouse.com.au, by email at inquiry@quantumhouse.com.au, or by calling our Sydney office on 1300-809-697. Thank you for your time today. We look forward to helping you make the most of your family trust, safely and compliantly.